point. Mine's basically what we're talking about. First quarter 2015 equity funds review, and as everybody knows, it was a wild quarter to be in the investment arena. January was a losing month. February was a big month, and March was a losing month as well. So it kind of added up to be a ho-hum piece because it really was a push. We ended up with positive returns for the quarter overall. But we'll go through a little bit in detail. Increase in volatility. The Dow basically for the quarter saw 16 triple trading days in March alone, which made it the second largest as far as trading days go on record. And so that's a pretty amazing feat. Basically, investors were caught between a rock and a hard place. Basically, ECB came out and said, hey, listen, we're going to do some big $1.1 trillion monetary easing. We're going to buy sovereign bonds and basically get the economy rolling in Europe. And I think people cheered that. Of course, then they had the Fed on the other side whispering in their ears saying, hey, we're going to cut soon. And so this loose versus tightening, loosening of monetary policy versus tightening of monetary policy certainly played on investor psyche. With that, we saw oil prices on the decline, some big losses. We've all seen it. Certainly at the gas station, we're getting used to that, $2.20, $2.40 a gallon gasoline. Who knows how long that'll last. And the dollar strength actually just continued on. Now, this was actually good for foreign groups, and so we're going to see here later on that we have China showing up, India regions showing up. Very strong performance. Japan did very well during the quarter, and it's because of this export concept. If we got a really strong dollar, exports from other country become very attractive, and so eventually people will start buying the exports, and that'll be a big boon for the foreign organizations in Japan and China, India, and the like. So again, we look at the January, this is kind of a big view. In January, we basically saw the ECB announce a $1.1 trillion bond purchasing program. This basically was a good thing. It was kind of at the end of the game for the month. But we also had news of the Swiss National Bank decoupling the Swiss franc from the euro. So there was some concerns really overall about euro strength and the like, and it really kind of put a dour situation on the month as far as investments go. Of course, we had the hostage crisis in France, and those are certainly issues that people paid attention to. In February is the best month in over 4 years that we saw in February. Funds were up about 4.9%. 94% of the funds reporting returns were in plus side returns for both equity and mixed assets. And then basically, this was based on hopes that oil prices stabilized and were going to stabilize. We had a tentative peace agreement between Russia and Ukraine, and of course, Greece came out and got a 4-month extension on its debt as far as the bailout goes. And I think investors saw that as a big move. Diversified leverage jumped to the top, 10.06% return. Science and technology did very well. And of course, in that case, dedicated short bias was in the seller. In March, we had a lower GDP. It's the first time we've had a lower GDP since 2008. So that was kind of a big statement. I think a lot of people were really pessimistic coming up on the earnings reporting season coming up. Now, again, tale of two cities. The Xetra DAX, German's market, was up 4.95%. The Nikkei was up 2.18%, while the Dow and the NASDAQ actually saw losses 1.97% and 1.26% respectively. So we saw China region funds up to 3.43%, doing the best. And then there was this merger and acquisition deals that were going on in the health biotech industry. So we saw health take a healthy jump in March as well. So let's go ahead and move on to our next piece. So U.S. investors were really expecting poor first quarter earnings, but overall we ended up with a 10th positive return for the quarter in 11. If you recall, 2 quarters ago we actually had some negative numbers, but world equity funds jumped to the top. This is something that they haven't done for a while. It's the first quarter in 6 that they jumped to the top of the group, so up 3.36%, and 80 of our 96 classifications saw plus side returns in first quarter of 2015. Health at the top, Japanese funds were up there as well, and global health were up there as well. So the really strong returns. And with the dollar weakness that we saw, this is going to be a story that basically is just resonates through the entire presentation. With the strengthening dollar, basically we saw the commodities, dollar-denominated commodities, just get crushed. Commodity agriculture was down 10.68%. Latin America funds, particularly those investing in Brazil, were down 8.95%. And then commodity energy funds were down 8.94%. So again, a pretty big downfall for anything that was related to the U.S. dollar. Here is what the next point makes for the quarter. The euro lost about, the euro actually dropped, but the dollar gained against the euro 12.73%. The pound against the pound was 4.98%, and just a tad bit against the yen. The dollar strengthened about 0.17%. Gold lost just barely amount, 0.08%, but oil was the big decliner, 10.64% for the quarter, and that was certainly a very big story at that. So if we move on to the next piece, basically we get our United States Diversified Equity Funds, and they were the second best performer in the category. This is the second quarter in a row that small cap growth funds have jumped to the top of this group, so 5.99% was certainly a big deal. And investors had a tendency to favor growth and small caps, obviously a reason for them being one of the top performers. Mid-cap growth was up there as well. We'll see kind of a chart here in a second of all the winners and the losers that were around. If we take a look at the month of March, it ranked number one, so it was the best group at mitigating losses at 0.30% in losses. Dedicated short bias funds did very well. Small cap growth equity funds were up 1.57%. But if we look at the bottom, we get the diversified leverage funds. Equity leverage is what we're actually calling them now. 3.97% loss, and our alternative ELCC.
120/20 funds.
Okay. Basically at 1.64%, just pulling one of those brain freezes real quick. So anyways, that was the story for our USD funds, and if we take a look at this, basically growth-oriented funds are at the very top, and if you look kind of the larger, better-known groups are towards the bottom, with, of course, dedicated short bias funds bringing up the rear. There's only 4 classifications that were in the cellar, though, for this quarter, and if we take a look at the large cap value fund, it was down 0.01%, so not a real big deal. So basically it was alternative equity market neutral funds and specially diversified equity funds, that, along with dedicated short bias funds, that took it on the chin. So as we look at the kind of the groupings that we have as well, we can see here what was in place. So mid-cap funds for the first quarter and 4 were the best performing of the classification groupings on a capitalization side, so 4.48% return. And of course, as I told you, growth funds were up 4.75%. If we take a look at the small cap growth equity funds, they were helped by, and this is by looking at Lipper active indices, healthcare funds sector, information technology sector, and industrial sectors were all in big play and actually helping push the small cap growth to its 5.9% return for the quarter. Nothing to sneeze at. Actually, very strong returns as that as well. If we take a look at our 4x3 matrix for the 1 month period, kind of the same story comes out. Small caps were more in favor, 1.47%. If we look at large cap funds, they took it on the chin, losing 1.34%. But for the 7th month and 8, we saw growth funds leading the pack, this time only to the tune of 0.08%, but it certainly remained positive, so that is a consistent story that we're seeing throughout. Taking our sector equity group at hand, basically, as it has in the past, the sector equity funds house 2 of the 3 strongest classifications in the universe, with health and global health being at the top of their charts. But it also housed 3 of the 4 worst performing classifications for the quarter. And of course, I told you this before, with the soft commodity prices and a rising dollar, we see that commodities, agriculture, commodity energy, and commodity base metals are all huge losers for the quarter and really took it on the chin. In March, though, we saw that the health biotech industry actually did well, and we saw that there was mergers and acquisition news as well in this area. So M&A deals in the health area, AbbVie announced the purchase of Pharmacyclics and really pushed and was a big player in the active indices as far as pushing the health industry, this big merger and acquisition. There was quite a few actually during the quarter, but this was one of the biggest plays and added some of the biggest returns to the group. Pushed the health and the global health to the top of the top of the group, and of course we had our for the 1 month piece, the exact same thing. They benefited from merger and acquisition deals as well. And of course, in the month we see that the dollar price commodities were pummeled again. We have the commodities, precious metals down 12.69%. Commodities, energies, we saw what happened to oil, down 7.75%. And commodity agriculture about 5.62%. I want to stay on that issue just a second, and that's only because we've been looking at the commodities and agricultural area. People are saying, well, we know that there's been some talk about beef and livestock and stuff like that doing a little better, but really we're talking about some of the soft commodities. So some of the like cotton, coffee, and particularly coffee has done very poorly during the quarter. And the reason I bring that up is brings us to our next group. That'll be a couple slides from now. World equity funds were impacted by that as well. Let's move on to the quick picture, though, that we usually look at. Basically, commodity prices really played havoc. And if we actually drag that up, we could go from natural resources down and even commodity precious metals down and see all the negative performance have almost everything to do with either oil, gas, commodities, or the like, or combinations thereof. So certainly that was a trend that we saw throughout the entire quarter, and we've been looking at that actually for the last 2 quarters. That brings us to the World Equity Funds Group, and despite disappointing Eurozone unemployment data, basically saw some big issues. The ECB, as I said earlier, agreed to purchase sovereign debt, and that $1.1 trillion deal just started this month, in March. So certainly that helped returns on the international side. Didn't really do all that much for us. I think it was kind of a push as far as that goes. But the Greeks' agreement to basically overhaul its reform and have a list of these overhauls of its reforms, the European officials actually took a lot of heat off the market in Europe as well. A lot of people were afraid that their government was basically just going to default and give up. They did not do that. And of course, dollar strength was good for exporters. So in this guise, we see Japan funds up 11.46%, China region funds up 6.59%. That was more on rumors that if the economy weakens anymore, China is willing to put more quantitative easy measures in the game. And of course, we've been talking about the Modi government in India region funds actually helping things out, up 5.58%. For March, we had some of the same stuff going on. Basically, we saw that China, Japan, Pacific region funds, and ex-Japan funds were okay performers. All the rest were negative. So we only had 4 positive returns for the month as investors, I think, basically started digesting some of the issues in Yemen and thinking about some of the concerns that are out there as well. The March brought world equity funds as the 3rd best performing spot, so they weren't at the top of the group as they were for the first quarter. And again, like I said, for the first quarter, they were up for the first quarter in 6, coming to the top of the group as well. One thing to talk about with Japan is the Japanese, the Nikkei, basically busted through the 19,000 market. That's the first time it's done so since April of 2000. On the flip side, as we look at the bottom, we got Latin America emerging market in both of the cases, and now India region for the month of March. But the Latin American funds got crushed because of commodity prices, again, oil and coffee and those type of things. And of course, if you look at Brazil, Brazil took up an even bigger whooping than some of the other groups out there, like Chile actually lost, because some of its base metals and the like. But India region, as you can see for March, also took a little bit of a beating, down 2.98%. But overall, I think a comment by the People's Bank of China kept both China region and also eventually India region funds in play as well, even though March was kind of a tough month for it. So now we take a quick look at the 4x3 or 3x3 matrices, and we see it's very similar to what we saw in the USD, with one exception. We saw core, was more favored only by like 3 basis points over growth, but certainly it was kind of a growth core and small mid cap run for both the international and the global diversified equity funds. And then looking at here, we see that basically the developed market funds were kind of in the middle, where with the exception of Japanese funds, which again had some export-related benefits, a lot of the exporters did very well over the Japan market. China, India, Pacific region, European is in there, but if we look at the international diversified and the global diversified equity groupings, are all in the middle or at the bottom. And of course, the big loser, as I said before, was Latin American funds as well. So that basically brings us to the end, and let's pop back up one slide, Jeff. I was going to just fly over this. Jeff and I were talking about it. It's not a real big deal. We know that a lot of people are putting money to work in our mixed asset universe. So we always want to show that they did well. Of course, there was no negative returns for this quarter. It was up about 1.99%, which is not a bad deal at all. Basically took the third place spot though on the macro groups as far as returns go. Of the four macro groups out there, at the very bottom was alternative event-driven funds at 1.21%. Mixed asset target date 2050 funds were up 2.79%, to give you a little perspective. The reason I like to circle around with this is as of February flows year to date, numbers showed that most people put more money into mixed asset funds than any other group. They put about 23.10, so $23.1 billion to work in the mixed asset funds. Out of $44 billion that was injected so far year to date through February. The next highest group was the World Equity Funds with 13.4%. So certainly mixed asset funds remain the big winner as far as draw of net new money. Concerns going ahead. Well, earning per share are not pre-announcements. I've talked about this before. This is from our brothers at Thomson Reuters. They've been helping us out for proprietary research, and they basically look at the announcements of forecasted pre-announcements for negative earnings. And there's 105 negative earnings so far for Q1 compared to 17 positive comments of pre-announcements. And this number is less than Q1 2004, so that's good as far as the overall number goes, which is 6.2. However, it is much higher than it was, so that was a year ago, by the way, for Q1 2014 compared to that. But over the average for S&P 500 is 2.6 since 1995. It's much higher. So there is concerns on earning pre-announcements that are actually more dour than they have been over the long-term history. ISM manufacturing numbers came in a bit lower, still an expansionary phase at 51.5 for manufacturing and 56.5 for non-manufacturing. But again, there is that slowdown effect that people are looking at possible slowdowns. Obviously, oil continues to put pressure on the market. And Yemen is kind of a wild card play. There was a late flight to safety at the end of the quarter, and investors were a little bit concerned that this Yemen play might cause oil prices to increase a little bit, which I think would satisfy the market a little bit. I think what the biggest concern was during the quarter at the very end was non-farm payrolls declined to 126,000, and also the prior month was also revised as well. And this is an issue of concern to me. Some investors actually thought this was a relief because it would take the pressure off the Fed of having to raise interest rates anytime soon. I see it as being not a good thing as far as 126,000. I'd much rather see 240 as was expected. But that in mind, easy money ahead. China's agreement to possibly do some more quantitative easing. Of course, the ECB's continuation of their new quantitative easing program was good for the market. Unemployment rate remained at 5.5, and I think one of the boons what we saw in this recent release a day or two ago was the average hourly rate actually increased 0.3% in March, and I think that bodes well for that the economy, people are still hiring, and that in fact maybe this $126,000 drop, 126,000 people drop in non-farm payrolls, actually that was the firm number, sorry, 126,000 will actually jump to 240,000 or above. $200,000 mark going forward. And of course, at the very end of this I usually look at our proprietary research folks, and there has only been a handful of reported pieces out there, only 18 companies that actually reported earnings so far. But of those 18, 83% of the S&P constituents that have reported Q1 earnings beat their analyst expectations. Well, that's it for me. I'll go ahead and pass off this presentation to Jeff.